So good morning, everybody, and welcome to our Operational Taxes Update webinar. It's good to have you with us today. So thank you very much for registering for this event. I hope you're all staying well. I just wanted to point out before we kick off with the main presentation, a couple of logistical points. In terms of when you look on your webinar screen on the right-hand side, you'll be able to view control panels, and this is where you can ask questions of the speakers. You can pose questions and we'll either deal with those during the course of the discussion or at the end. So please feel free to drop questions into there. Equally, if you'd like to send us questions by email, our contact details are provided at the end of the slides, and we'll follow up with you separately. The webinar is being recorded today and will be distributed to everyone that's registered for the event. And obviously, once you receive that recording, you'll feel free to share it with colleagues. And finally, a number of us are working in different locations today and different countries even. So we apologise in advance for any unexpected interruptions as we are remote, but hopefully they'll be kept to a minimum. And we hope you enjoy the webinar today. And thank you very much for your understanding. So briefly, in terms of introductions, I'm Martin Keller. I'm a tax partner in Grant Thornton in the UK. I'm very pleased to host today's webinar with an operational taxes update at the end of half year of 2023, if you can believe that. And today I'm joined by two colleagues. I'm joined by Jasmine Chan, an Associate Director in the UK team who works with me on operational taxes. And I'm very pleased also to be joined by Marcus Helios, who is a tax partner in Grant Thornton, Germany, who leads the financial services tax business there. So it's good to have a number of colleagues with me today. And in terms of the agenda for this morning, in terms of running time, we'll obviously close before 11 o'clock. Our plan is to run for probably about 35-40 minutes in terms of the content to allow a reasonable amount of time at the end for any questions and further thoughts and comments on the material. But in terms of the agenda today, we'll be covering off, first of all, Marcus will be covering off the proposed changes to what are now like the new changes coming in on the German withholding tax reclaim procedures, as well as some commentary around the new EU proposals around the faster tax reclaim process and its likely impact both in the German market and more broadly. And also Marcus will give an update on current developments around the ongoing Cum-Ex investigations, again focusing on the German market, but again looking at what the impact is and actions that people are taking around that. Then hand over to Jasmine, who's going to spend some time talking through the new QI agreement that became effective from the 1st of January this year, and in particular focusing on the larger technical changes, which we are finding clients are still getting to grips with, particularly the changes focused around US publicly traded partnerships. And then finally, I'm going to give you an update on where we are at with respect to a number of new information reporting initiatives. It seems that we are in a season of a number of big changes in this area. So I'll speak about the crypto asset reporting framework, the upcoming changes to the Common Reporting Standard, as well as some other EU-specific directives around DAC 8 and CSOP. As we know, they are occupying a lot of our clients' time at the moment in terms of assessing impact and ultimately implementing new compliance procedures. So without any further ado, I would like to hand over to Marcus, who will talk on the new German reclaim process. Thank you.
So thank you so much, Martin, for the introduction. Hello, everyone. My name is Marcus Helios. I'm tax partner in the Frankfurt office of Grant Thornton in Germany. I'm the leader of financial services tax in Germany. And like Martin mentioned, in the center of my presentation, or I will present the changes that have been proposed recently to the German withholding tax reclaim procedure. Afterwards, I will give an overview about the proposal of the EU Commission regarding FASTER, and last but not least, a short overview about the recent developments regarding Cum, especially Cum-Ex in Germany. When we can go to the next page, please. Yeah. When we speak about German withholding tax reclaims, I think it's very important not only focus on the legal side, it's also important because of the scandals we had in Germany regarding withholding tax reclaims in the context of dividend arbitrage transactions, is to look how is the relationship between the Federal Central Tax Office in Bonn on one side and the tax advisors and the taxpayers on the other side. And I want to highlight 4 bullets that give you a flavor about the situation we have in Germany. So the first point is that the processing time for the withholding tax reclaims increased. This is because of lack of staff. Then there is still a fear on the tax authority side that there are still some CumEx or similar transactions in the market. Then also the allocation of new responsibilities that triggered that it takes much longer to get the withholding tax back. Then we have from the year to year a perspective. We just observed a strong increase in the number of reclaims have been filed. I think it's also one of the reasons for this strong increase that we are in the middle of the phase out of paper reclaims. I will give you the meaning about this. I will explain on the next slides. Then, can you go back, please? Yeah, so then big problem is that there is no shortcut or like a fast track for simple cases. The tax authorities are really working from the date of receipt. And so even if there are so many simple cases, you need to wait when all the other reclaims have been worked through. And last but not least, the last bullet here, it's really hard to get somebody on the phone. If you are interested about the process of your withholding tax reclaim, first of all, it's difficult to get somebody on the phone. And if you are really lucky, after a million attempts, this happened to me, they will tell you that we cannot give you any update or answer to your questions regarding the withholding tax reclaim. So to the next page, please. Thank you. So when we speak about German withholding tax reclaims, we need to differentiate between different types of reclaims. We have our German tax law. I think it's similar to the law you are confronted with in Great Britain. We have reclaims that are based on double income tax treaty reclaims. We have also domestic tax law reclaims. And German investment tax reclaims are in a separate regulation, and other EU law-based reclaims are also under European subsidiary directives. You can go to the next page. So when you differentiate between the different types of reclaims, it's also important to differentiate between the technical requirements. If you reclaim withholding tax according to applicable double income tax treaty reclaim, there are, let's say, different rules you need to observe and to follow. And you see that, especially regarding the double income tax treaty reclaims, this is limited to 10,000 K per dividend reclaim, and is also not applicable for investment funds in terms of the Investment Tax Act, and also if you want more than the standard treaty rate. The paper-based reclaims, we still have until end of this month regarding 2019 reclaims. We have there 2 different paper forms, and super important for this, for our context today, is that the paper-based reclaims will phase out in 2 days, as you see, the 3rd of June this month. And this year for 2019 reclaims. In the background, the banking association are really hard lobbying for prolongation, but I don't think that they will succeed. So I think that from the beginning of the 1st of July, the paper-based reclaims are not applicable anymore. So then we have then the electronic reclaims for the 2019 reclaims, and we will see what new electronic mass reclaim interfaces will be applicable and enforced as of, as you see, at the moment, we don't have more information about the time frame. Go to the next page. Yeah, very interesting is that when we speak about the new electronic reclaim, is the web-based online on the Federal Tax Office website. It's a tool combination of Elster. Elster is a very common software tax advisors are working with to file tax returns for their clients. And this is like an enhanced version of Elster, and everything is only possible in an electronic way. And you see in the last box on this page, I try to summarize pros and contras for or against the new reclaim form. Many of our clients here in Germany, especially the foreign banks, they are super afraid that that they are confronted with new legal risk, because the person who's working for a bank and is filing as a representative of their customers, is he giving an own declaration regarding the withholding tax reclaim, or he is giving a declaration for the customer? And at the moment, the German tax authorities are of the opinion that the bank are giving their own declaration. So it's a risk that that the foreign bank who's filing the withholding tax reclaim, and the withholding tax reclaim is not based on right information, and this could lead, and this is the thinking of our clients, could lead to criminal law consequences, to liability consequences, and so on and so on. You see here, completely manual processed. It's reset that for the time being. There's no upload function, but you can just some text vouchers you can upload. You would see maybe just for their home study, here are some cons and pros regarding the new withholding tax reclaims. And this is what our clients are confronted with from the 1st of July this year. Next page. Good to know for the people who visit or join this webinar. The information are also available in English on the website of the Federal Tax Office. You can see here the link, and you can read more about the technical requirements, and it's also a good translation. So the German tax authorities are really trying to get more international and help foreign investors to get their withholding tax reclaim. So this is the situation we have right now in Germany. And now to the next page. So you see last week, on the 19th of June 2023, a press release has been published on the website of the European Commission. This is it's about starting 2027. What is the content of the press release? The thing is that the EU plans the introduction of a digital tax resident certificate. This digital tax resident certificate is necessary and the basis for the introduction of a new, let's say, fast-track procedure. And this new procedures, you can differentiate between relief at source and a quick refund. Relief at source is that if all the requirements, and we are just speaking about a highlight press release, there are so many details still open and will be discussed. The relief at source means that you get the payment without any withholding tax. And the quick refund procedure is this what I just presented right now, what we have in Germany for most of the reclaims is it's a refund. It's not a quick refund we have, but the plan of the European Commission is that, yeah, if all the requirements are fulfilled and we have really an EU-wide digital tax residence certificate, that the refund for any overpaid taxes should be granted within 50 days from the date of payment. So, and last but not least, this new system is embedded into a new standardized reporting obligation system. This all lives from a new definition of some certified financial intermediaries. These intermediaries will have to report their payments to the relevant tax administration, to trace the transaction. And yeah, we will see on this page is more or less a comprehensive summary of the press release of the European Commission. So far, we don't have much more, and we will see in the next months, more details. And based on this more details, we will have then we should have a new webinar to give you an update about the details. If you can go to the next page. Martin Killer asked me what are the first conclusions and what is the first impact on our new German withholding tax reclaim system. As you saw, the German tax bureaucracy, the authorities are going to a more digital way. Of course, the plan is to work faster regarding the withholding tax reclaims. But this new proposal of the European Commission is, of course, something totally new. So we will see, will also change the German law. But what my first impression, the first reaction was that it will trigger, and you can read it here in the second bullet point, it will trigger a lot of costs, I think. It's like, I remember 2009, the introduction of the German Flat Tax Act. It was so expensive, and I think that faster, even if the investors really get faster their money back, it will trigger on all sides, not only on the investor, not only on the bank sides and on the tax authority sides, but also on the investor sides, a lot of money. And why a new system? This is the last bullet point on this page. I was thinking that faster is based on various ideas. The one idea is that the investors get their money faster back. Then it's also that if there are some dividend arbitrage transactions, that will be more easy to identify them, to change the law, to limit any tax abuse transactions. And I think also without the introduction of this new bureaucratic monster, let's say this, what we are confronted with based on the ideas of the European Commission, it would be, from my perspective, more easy just to introduce a final withholding tax, what we know from in Germany for the private investors, but also my idea, if we expand these rules on income, dividend and capital gains, also for corporations domiciled in Germany and also outside of Germany at a rate of 15%. That would also solve a lot of the problems the European Commission will solve with faster, but I think it's more easy if we just change the tax rate. So last but not least, I think I'm on the next page. The current developments on CumEx. It's just one page I prepared. This is like flavor of our yellow press in Germany, and not only yellow press, also the press releases from business magazines. You see that we have now the second conviction regarding with respect to Hanno Berger, mastermind of CumEx. We have so far we see again more house searches we're doing by the police, especially the banks from France are in scope right now. And I think that a new dynamic will start in autumn of this year, because then the next big trial starts here close to Frankfurt against two former tax partners of Freshfields. So far, Hanno Berger got the second conviction not with respect to his tax advice. He got the conviction because he was doing the trading by himself, and we are still waiting for the first court decisions regarding the role of the tax advisors in the context of CumEx. And we will see this, I think, in the autumn. We will see the first convictions of tax advisors in this respect. Thank you so much. I hand over to Martin or Jasmine.
Thank you, Marcus. So today I want to talk a little bit about the new QI agreement that came in December 2022. So it was a lovely Christmas gift that the IRS gave us before the end of last year. It was something that we were expecting to come in. I guess it was just very timely in terms of just before the end of the year. But in terms of the main changes that it covered, it's across this slide. One of the main changes that it did cover is the 1446F changes in respect of PTPs, which are publicly traded partnerships. And I've got a couple of slides later on that go into that in a little bit more detail. So for now, what I wanted to talk a little bit about is some of the other main changes that came about as a part of this new QI agreement that was released last year that applies from 1st of Jan 2023. So some of the key changes is the reconciliations that are required. So previously, in respect of 1042 and 1042S reconciliations, this was only expected to be, this was expected to be done by QIs for all years and, on an ongoing basis. But in terms of what needed to be demonstrated to the IRS, previously you only needed to show the 1 year that was selected as part of the periodic review, and it would be covered as part of the checks that are done as part of that review. The new QI agreement stipulates that this is now required for all years, essentially, and you will need to be able to provide those sort of reconciliations and workings to the IRS as well. So that's something that will need to be done, but hopefully it isn't a big change in the sense that it was already being done, but it's now something that you need to submit. Another big change that has come about is the periodic review report. So in the past, when you go through the certification process, there's always been an option near the end to upload your periodic review report, but that was never a mandatory option. It was optional, and it would not stop an RO from doing the certification if they didn't want to upload that report. But that is now a requirement going forward, so that report will need to be uploaded. What I would say is when you're doing the certification and you're filling in a lot of those fields, they do link to the periodic review report anyway. So providing that report shouldn't provide anything to the IRS that you wouldn't already do. It's just giving them a little bit more information, which will hopefully mean that they understand your certification in more detail, which will hopefully result in less questions. But that is definitely something that is changing, and will, the ROs will need to be ready with the report before they can do their certification, because they will not be able to do it without uploading that report now. Another major change that came in as part of the new QI agreement is under the old 2017 agreement, in instances where QI had over withheld and did not apply the collective refund procedure, the QI is obviously required to provide recipient-specific 1042Ss to the account holder to facilitate that kind of process, that reclaim process. Now, the 2017 agreement didn't provide a time limit for when those requests need to come in. And under the new agreement, they've provided a bit more kind of structure around this. And now account holders should generally be requesting the 1042Ss within 2 years from the year of payment. So that just gives a bit more structure to the QI. So then they know within that 2 year period, they need to be ready to provide those 1042Ss on request by the account holder. And another thing that's not specifically covered in the QI agreement that I wanted to just call out is that the RS are moving the 1042 forms to an electronic filing process. So that's not something that it was a big shock. We knew that they were looking to do that for a little while now, because in the past it's always been paper submissions, but the 1042Ss have always been electronic for a large number of years now. So in 2022, the 1042 form, that there was an option to file that electronically, but you could still file that in paper. And it is expected that that will slowly transition. So in the future years, it could potentially be mandated for the 1042 forms to be electronically filed. Okay. So if we move on to the next slide. So this slide talks a little bit more about PTPs, which, like I mentioned, was covered in a lot more detail in the QI agreement. So under the 1446F rules that covered PTPs, the QI is required to withhold 10% on amounts released from transfer of a PTP for all non-US persons, and that applies from 1st of Jan 2023 onwards. And this slide essentially just summarises that a QI can assume a number of different statuses, and that will impact whether or not they are essentially a withholding and or what is called a disclosing QI. Now, the terms here are slightly different to the QI and NQI concepts, but it's not too different, and a QI can have a different status for 1446F and non-1446F transactions. So you could be withholding or disclosing for one and not the other. But generally what they mean when they say it's a disclosing QI is it is one where you are required to collate and pass upstream the W8 and 9 documentation that you've collected from your account holders and pass that up to your withholding agent. So there are similarities between what would be a disclosing QI for 1446F transactions and an NQI for the other type of transactions. And what we're seeing in the market is, depending on the number of holdings in PTPs and the impact, most QIs have tried to, or made a business decision to remove investments in PTPs prior to 2023, or at least say we're not going to hold any more and we're just going to maintain the existing PTP holdings until they're sold. So depending on whatever your business decision is and what you've decided to do, you need to obviously make sure that you've got the appropriate controls and processes in place to make sure that whatever the position is, that you've got that covered, whether or not you are going to continue holding them or not. And what I would say is, even in instances where you've said, we've made a business decision to not hold PTPs anymore, and you tried to divest all of those prior to beginning of this year, is how are you making sure from a controls perspective that you're not going to purchase new PTPs and make sure that those don't kind of slip through the net, and how are you monitoring your holdings to make sure that a non-PTP doesn't, for example, become a PTP. So these are some of the factors that need to be considered, because once you do hold a PTP and you need to sell that for whatever reason, that's when 1446F comes into play, and that's irrespective of what your position might have been pre 2023. Okay, so if we move on to the next slide, what I talk about here is a little bit about some of the additional changes that come in respect of 1446F. So the top part I've already talked a little bit about. So what I wanted to reference here really quickly is the bottom part, which is the key changes to these rules since the new agreement was released. And there's two key points that I wanted to call out. The first one is in respect of US TINs. Now, previously there was a requirement for US TINs to be collected for any accounts trading in PTPs, which basically meant that all non-US persons would also need to get a TIN. And this was one of the kind of major kind of sticking points and pain points for a lot of a lot of QIs and intermediaries prior to this clarification coming out, because it would have been quite difficult for them to get these tins. Now, as a result of notice 2022-23, that's been relaxed, that requirement. So QIs now should be collecting these US tins on a best effort basis. So that's one that, if you don't have it, it's not the end of the world, but you should be at least reaching out and trying to obtain them. And another big change is in respect of notice 2023-8, which is where the IRS confirm, the US regs would be amended such that where entities that are organised outside the US and trade only on non-US stock, the broker in that instance may presume that the entity is not a PTP for US tax purposes and hence not be required to withhold that 10% in respect of 4046F rules. So that's definitely something that has helped the position. The caveat to this exemption that's covered under notice 2023-8 is that it doesn't cover, obviously, instances where the broker has actual knowledge that it is a PTP. So it just gives brokers a bit more comfort that they're not required to investigate the position, and if they have no knowledge that it is a PTP, they can work on that basis for the purposes of these rules. So if we move on to the next slide, this final slide that I've got just covers the various factors that QI should consider off the back of the new QI agreement and the 4046F rules. So hopefully by now you should have already renewed your QI agreement. That deadline has unfortunately passed. So if you've not done that yet, you would need to reach out directly to the IRS, or it's definitely something that we could help you with. But you would need to reach out to the IRS because that option to renew on the QI portal has now gone. We know that the IRS are still working through instances where people have applied under the new QI agreement and it hasn't, the status hasn't changed to accepted yet. So we know they're working through them, and we know that some QIs have had that status updated while others have not. So just please just keep monitoring that on a regular basis. Other things that you should do is, like I mentioned on PTP holdings, is hopefully by now you already have a business decision. And whatever your business stance is regarding these holdings is, you should make sure that your controls are put in place and clients are notified. So what are the communications that you're doing to that you've sent out to your clients in respect of those that held PTPs, and to make sure that they are aware of what your stance is for the future. If, say, for example, a client wanted to start investing in PTPs, has those communications gone out? So then they're aware of the kind of service that you will be able to offer them. As part of the new QI agreement, and obviously the next certification that's coming around, ROs should also consider which year they want to select as part of the review, and that obviously can have an impact on whether or not it's the 2017 or the 2023 agreement that applies, depending on the year that you select. So that should be selected on the QI portal when that's all updated, and obviously as per the 2017 agreement, depending on the year that you select, it will also impact the certification deadline. So between now and the certification deadline, the RO should start thinking about what have they got in place to make sure that they are ready to certify. Have they got the reconciliations ready, or do they have processes in respect of annual 1042 and 1042S reconciliations to cover the new points? And those types of things, like how are they monitoring training? Are they keeping training, for the business up to date to make sure that the RO is in a good position to certify by the deadline? Okay, and that's everything that I wanted to cover for this point. So I'll move on to the next slide and hand over to Martin.
Thanks very much, Jasmine. Thanks, Marcus, as well. Great stuff there. Lots of change, and obviously lots of things to be keeping people occupied over the next few months, and I'm sure years as well. So we're at 10:36, so I'll canter through the stuff. I just wanted to pick up very quickly on a couple of things just from the QI side. We did have a question come in from one of the attendees asking about, is uploading a periodic review report mandatory if you're applying for a waiver? So in general terms, if you're applying for a waiver, that typically will be a waiver from actually having to undertake a periodic review report. So when the waiver is submitted, typically by 1 July of the relevant year, you won't have actually undertaken a periodic review report of that periodic review at that offline. So I think the short answer should be no. Well, no, there's no facility to upload a report. Obviously, if you have had a review undertaken, then you logically wouldn't be applying for a waiver. So I'm happy to take up any points on that offline if there are any further questions underpinning that. And the second thing just to point out is anyone that's an RO on the call or a point of contact from a QI perspective, probably, well, hopefully we're aware the IRS are actually coming to London at the end of July. They're going to spend their well-earned dollars in London shops, I'm sure, but they're going to be at the US Embassy on 2 days at the end of July and giving a briefing to QIs and holding agents on the latest reporting requirements and obviously the new agreement, and they'll be available to answer questions. So if you need further information, please reach out to us. Contact details we provided, but certainly the IRS again are keen to engage with industry to understand any pain points with the new agreement and the new electronic filing requirements. So that's QI side. So just in terms of what I want to cover off now, in terms of crypto asset reporting framework, if we just move to the next slide, please. So in terms of, as generally as a starting point, the pace of change in this, or change of pacing in this area, I think has accelerated a lot more of late. People will notice from the amount of material, the broadness of the material we're covering today. There's a lot of information coming through and a lot of activity from tax authorities generally that we are seeing, probably on a magnitude or a scale probably not seen since the sort of onset of FATCA about 12, 13 years ago when the US started talking about this. So it's probably not uncommon given coming out of the pandemic and given tax authorities' desires to raise revenue and to focus on the financial industry to try and obtain more data in order for them to then understand where people are maybe not satisfying their tax obligations is something we would have expected anyway. But I also think post even absent the pandemic, the change in many financial trading models, new entrants to the market, and just brand new products that have arisen in the last few years, the various tax regimes were always envisaged would need to be updated to take account of those developments. And clearly there's a desire for increasing use of data that's been obtained by financial institutions as part of their ongoing due diligence processes for that information to be provided to tax authorities. And I think we're going to see much more of an alignment between some of these rules and underlying KYC and AML rules. We've seen already, in fact, in CRS terms, but equally, I think more of that understanding and that cross sort of combination of skill sets is going to be more important as we move forward into the next few years. So obviously here are a number of things we've talked about, we talked about already as well in terms of the QI and exchange of QI rules, and obviously audit activity generally, both in the UK with HMRC is likely to increase over the next few years, clearly in terms of the HMRC responding to OECD pressures to ensure that there is a suitable level of governance and credibility around managing CRS compliance in the UK. But equally, audit activity from the IRS in conjunction with QI, but also with FATCA, and how that impacts then on other countries that have entered into the governmental agreements with the US to implement FATCA. There is a big focus around how that audit activity from the IRS will then spring into action in the UK and other jurisdictions that have got those agreements for FATCA. So if we just move forward into the next slide, I just want to touch on the crypto asset reporting framework. So we've, in terms of where we're at currently, the OECD have agreed the final text of both the crypto asset reporting framework and consequential other changes to be made to the Common Reporting Standard. That was at a meeting a few weeks ago at the OECD. So where we are at currently is the core principles of the CARF, as it's called, are definitely in scope from what the OECD have now provided. So in terms of the scope of the kind of assets that are to be captured by the new rules, and the kind of entities that will also be subject to the reporting provisions has now been decided. And it's very much, as we've talked about on previous webinars, a transaction-focused reporting as opposed to just reporting on accounts that are held by customers at a particular point in time. It's very much focused on understanding the whole crypto universe and the number of transactions that are they're undertaken between different parties in the crypto framework, and that's very much coming through in the final rules. And it very much builds on the basics of what FATCA and CRS were about in terms of for new entrants, so people who have not had to undertake FATCA CRS before, or business units which are now within existing organisations which are looking to or have now offered crypto-style products. It's in ensuring that the due diligence procedures which have been already introduced for FATCA and CRS are read across for these crypto businesses, and understanding the types of users, both entities and individuals, that hold these products, to determine their tax residency, and particularly for entities, their status under the rules, to ensure that the crypto asset providers are able to report to their home jurisdiction on an accurate basis. And ultimately that information will then be exchanged with the tax authorities of the residency of where the users of the crypto assets are based, as we currently have for CRS. With some accelerated reporting timeframes envisaged as compared to FATCA and CRS. If you just move to the next slide, please. So there is obviously some overlap or interaction. I mean, pure crypto traders who are trading particular types of currency and other types of crypto products will be covered by the CARF itself, and will have to generate or implement new procedures to be compliant with the rules. But equally, where there are things which sort of cross or transcend between traditional financial products, so for example, there's certain electronic money products, electronic wallets, and other products offered by electronic money providers, and equally central bank digital currencies, they have been specifically excluded from the CARF rules on the basis they will be incorporated into the changes to CRS to be implemented on an equivalent time frame. I think it's fair to say at the moment up front we don't have a final implementation date for the CARF and the CRS changes. Certainly people were envisaging originally these rules would be implemented by 2025, but that isn't necessarily clear cut. And obviously in the UK, we await now a series of consultation documents from HMRC to cover both the CARF and the CRS changes, which will be socialised with the industry to allow for feedback and ultimately for new UK regulations to be produced, and ultimately new guidance to be updated by HMRC to take account of these new rules. So the other point to mention is there, in terms of the interaction between CARF and CRS, is where you've got something that could be potentially reportable under both regimes. There is a clause in the CARF document which allows for reporting to be undertaken under the CARF rules, which I say will shift it to a transaction-based reporting process and potentially lead to an accelerated reporting time frame. Certainly under the OECD documents, there's potential for reporting to happen certainly in the first month or two following the end of a particular calendar year, as compared to what is currently done for CRS, depending on the jurisdiction. Indirect investments in cryptos, for example, where you have a traditional financial institution holding interests in crypto in a custodial capacity, or equally, some other kind of financial instrument that references the underlying value of a crypto asset, that is expected to be covered by the existing CRS rules, and hence the changes to CRS reporting to be brought in over the next few years will also apply for those kinds of arrangements. And also the new CRS due diligence procedures that apply under the changes to CRS, will also read across into the CARF as well. So that's another important change, another important point to note as you're looking at the impact of these rules alongside each other. We just move to the next slide, please. So in terms of the impact, as I said, we are, for the CARF rules in particular, we're expecting a go live potentially, I think now more likely 2026 at the earliest. But certainly in terms of the timing, given the length of time it takes to understand the impact of the rules and to address systems changes and to obtain budget approvals to allow for a proper implementation over a sustained time period, we were expecting most organisations to be undertaking impact assessments from now onwards, obviously with the rules we have already from the OECD, but obviously aligned with that, we've obviously got the HMRC consultation to be expected, followed by, as I say, UK regs and guidance to be provided. So certainly over the course of the next 6 to 12 months, I would envisage most organisations undertaking some form of impact assessment to determine how the CARF regime will apply to them. And following that, the period of implementation required and testing in order to ensure readiness for reporting, as I say, probably likely from 2026 onwards. And coupled with that, obviously, the element of training and building up staff knowledge and awareness across the broader organisation to allow for that governance framework to be introduced on an equivalent time frame. Just moving to the next slide. So in terms of the amendments to the CRS, again, these have been trailed in the OECD documents. I think the key things here to focus on outside of the particular products, and I've called out already that are subject to the CRS rules rather than the CARF, is the changes to the definition of financial institution and financial asset. So particularly on the depository institution side, the rules will be broadened to encompass a wider range of electronic money institutions as depository institutions, as opposed to just traditional banking and other deposit-taking functions. And we're also seeing more clarity in the rules around the definition of investment entity. So again, funds, which traditionally fall into the investment entity category, there's no question that those collective investment vehicles will be caught as investment entities, and further guidance to be provided around other types of institutions that could be caught as investment entities. That's, I think, a key area there. And the broadening of financial asset, the definition of a product level to be in scope. We're expecting obviously crypto assets and themselves to be included as a financial asset, whether traded directly or issued directly by a crypto provider, or held in custody, or treated as part of a fund investment. Again, all those kinds of crypto assets will be caught under the rules moving forward. I guess the big issue for a lot of existing reporters under the CRS regime is the changes to reporting that have been provided in the OECD documents. So there we're seeing more granular information around the type of controlling person to be disclosed. That's going to require further due diligence to be undertaken by institutions if they've not got that information already in their databases. The treatment of new versus pre-existing accounts, the differences obviously are well known in terms of the difference in due diligence approach, but when it comes to reporting, there will be a requirement going forward to actually focus on whether the account is new or pre-existing, to allow tax authorities to understand better the type of information that's being reported alongside that. The question of valid self-certifications, again, will be a requirement to actually determine, to note on the report whether a valid self-cert has been obtained as part of the onboarding process. And again, we've seen other countries sort of move ahead of that already, in the likes of Germany and in Jersey and Guernsey, where already there are requirements to flag to tax authorities early on where the self-cert's been provided. This will now codify across the piece, for CRS, that you'll need to provide that information as part of the reporting. And also the type of financial account, whether it's depository, custodian, etc., the nature of the account will also need to be disclosed to tax authorities. There are certain exclusions. We won't harbour on too much at the moment, but there are certain exclusions, and obviously the non-reporting by category for charities in particular. We'll await further clarification from HMRC, particularly on how that will work in the UK scenario. But certainly there's some helpful discussion in the OECD document, which will help to iron out some of those issues as well. So move to the next slide, please. And this is really another equivalent timeline, but for the CRS changes for those institutions not so worried about the CARF, but more focused on the CRS changes. I think it's fair to say amongst our client base, very few organisations have really undertaken a detailed impact assessment yet, pending further clarity. I think we have that clarity now from the OECD level in terms of where these rules are heading, and we're obviously awaiting consultations from HMRC and other tax authorities across the globe to implement the changes, which will see further information provided. But certainly, I think now is the right point where people, particularly those thinking about those specific reporting changes, will need to think about the impact on their particular businesses and thinking about how they address an impact assessment either on an institution-wide basis, or probably more likely on a business line by business line basis, given many of these existing processes where they have been implemented have been tweaked specifically to deal with retail versus corporate versus institutional customers. So I would envisage impact assessments being run on a business unit level, particularly for the larger financial institutions. And then moving forward over the next year or two, again, subject to the question mark of when the rules actually finally land in terms of implementation, whether it's 25 or 26, building those additional bits of the system to enable the implementation of the new reporting changes. We're obviously going to expect new reporting schemas to be provided by the OECD, and then to see how HMRC react to that in the UK in terms of how that will look in terms of the reporting requirements for financial institutions. And I think even absent the detailed rules in the UK, we know the focus on obtaining self-certifications is going to be highlighted through the reporting process, but now is really a good time as any to be looking really at the data you currently hold on customers and understanding where there are gaps in self-certifications to be ready for that new reporting obligation coming in a few years' time. So fair to say you can't ignore these changes. They're going to come through. They're going to be implemented in the UK. There's going to be some level of consultation, but clearly now is the time to be really focused on thinking about how you can get ready for when these changes do come in over the next couple of years. Just move to the next slide, please. So another couple of things just to mention very briefly. DAC 8 is the European directive, which effectively encompasses what was covered by the CARF and by those CRS amendments. So within the EU, for those attendees today that are more focused on the EU rather than the pure UK market, ECOFIN had agreed final text of the DAC 8 in May, and we're expecting final sign-off by the EU Parliament in the coming weeks. It's envisaged the start date for DAC 8 will be 1 January 26. And as it currently stands, based on the text we've seen from the European Commission, the DAC 8, the technical elements of DAC 8 will mirror, largely speaking, what is in the CARF in terms of the definitions of types of products that are in scope, and also the types of institutions which will be caught by the CARF, by DAC 8. There is still a question mark that DAC 8 potentially extends extraterritorially, as outside of the EU at least, as compared to the CARF, which is focused on what goes on within a particular jurisdiction. And also, there's other information. So, as the DAC 8 itself is an amendment of existing DACs, which have been implemented under EU law, which encompasses all the various other rules around, for example, DAC 6, which is a different type of disclosure. There are other elements included in DAC 8 which won't necessarily take effect from the same point at which the crypto and the CRS changes will take effect. There is some discussion around the penalties to be applied, which will fall on EU member states to determine. But we're already seeing obviously a varying degree of what type of penalties will be applied across different jurisdictions, as we have with CRS that's been implemented already across the EU. So therefore, things to focus on in the EU are very much around understanding the implications for EU-based crypto intermediaries and the EU financial intermediaries generally, where the CRS changes will bite, and understanding how the additional reporting requirements will bite as well in the next few years. If we move on then to the final slide I've got, which is on CSOP, Central Electronic System of Payment Information. So this is let's be clear, the timeline for this is very, very soon. The rules kick in from 1 January 24, with the first reporting due at 30th of April. So it's new quarterly reporting across the EU. This is very much, the rules are envisaged around VAT anti-avoidance, and a desire across the EU to obtain much more information from payment service providers, which will include banks, electronic money and other forms of payment providers across the EU, to share information on cross-border payments within the EU. So I think it's fair to say these rules are very broad. They encompass all manner of bank and other types of credit transfer made by banks and other institutions. A number of banks, particularly large institutions, have commenced impact assessments on this, notwithstanding the rules are not a million miles away in terms of go live date next year. And also implementation across the EU of these rules is very varied. Of the 27 EU member states, I think we've only seen less than 10 produce final legislation, and a number of others have got draft legislation in place, but we're still, a number of countries have not produced what I would call detailed legislation or even any kind of initial guidance to steer domestic institutions how to implement these rules. But it is very close to being implemented. And there is a big interaction with GDPR, so notwithstanding the broad nature of the types of payments need to be reported on, you do need to consider obviously the impact of over-reporting, whether that could then contravene GDPR and other provisions within the EU. So there is certainly a lot of thought there around looking at systems intended to incorporate all those amounts of data. And I suppose the other question that you often get asked is, why is it being dealt with at an operational tax level as opposed to purely within a VAT function? And that really is down to the nature of the beast and around the fact that it is such a broad reporting regime, and the kinds of processes and the understanding of the operational level as to what is in scope very much encompasses a broader organisational approach, both in terms of tax technical needs, in terms of understanding the tax rules, but also the nature of where the payments sit, the type of systems which need to be interrogated to understand where these payments are made, how the payments are made, and ultimately generating a program or a tool that actually then feeds through into ultimate reporting and deciding how that reporting will actually work is very much a broader thing than just looking at pure tax functions, which is why a number of organisations have focused this within their tax reporting or operational tax function because of the broad nature of the rules and the fact that clearly operates, the rules will need to be considered across different EU jurisdictions, very slightly different, bearing in mind the local legislation that is finally released will be slightly nuanced, and obviously penalty regimes equally will vary across different EU states, and therefore the approach may partly be determined by the level of penalties and the level of the tax authority interaction with institutions around this. So on the blue box on the right hand side, very much people who have looked at already our impact assessment stage and trying to assess the likely reporting requirements and how they will achieve that, whether internally through existing systems or through third-party software, and also how to file returns on a pan-European basis and also on a quarterly basis, also being considered quite carefully. And therefore, ultimately, people are thinking about how they're going to collect the information, ultimately retain it for further or for future audit interrogation by tax authorities. It's envisaged there will be a central database where all this information is sort of literally thrown into by different financial institutions, but ultimately, obviously, there will be a need for assessment at the tax authority level. So therefore, the audit regimes will be appropriately designed around that to enable tax authorities to understand what's in the data and ultimately trying to clamp down on what they perceive to be some elements of VAT fraud across different member states. And also impacts payments that are coming in cross-border, both within the EU, but also EU coming from third countries into the EU as well. So very broad nature of the rules. I appreciate I've cantered through the CSOC bit very quickly. So now, quickly at 2 minutes to 11, I'll open up to questions from anyone else or any other thoughts from the panel. So we move to the next slide, please. I think one after, yeah, thank you. So all our contact details obviously are here. We're very happy to obviously receive any emails, telephone calls, or whatever, or follow-ups. If you've got any questions on any of the information we provided today, appreciate there's quite a lot of information there, and obviously quite a lot of things which will take time to digest and think about how you consider the impact for your organisation. So please feel free to reach out. So at that point, I'd just like to say thank you very much for joining us today. We do hope you found the presentation useful. Over the coming days, we'll share a copy of the recording and the slides with you. So please feel free to share with your colleagues. And as I said, if you've got any specific questions, please don't hesitate to reach out to us in due course. There is also on the following this slide information about our other FS-based events we are organising from Grant Thornton, and there is also an email address fsgevents@uk.gt.com, which is also your link to understanding further events we're organising both in the tax space. We've got a number of webinars coming up, particularly for banks and insurance companies, but also we have regular regulatory and other risk type webinars, which again will cover off the broader regulatory developments across the UK and more globally. But thank you very much for your time, and hope you have a good day.